I hope my screen is visible, everyone.
Yes, yes.
Okay, thanks, sir. So, look, today's session is a little off topic, so to speak. Uh, so, this is basically on at least how a few of us, and especially me, we look at markets from a macro point of view. This is a more though macros are supposed to be fundamental. How do you use this fundamental approach for planning for your week ahead, for your trading week ahead, getting the sense of what are the things that may move markets, both in India, if you're trading only Indian equities, or if you're trading foreign exchange or precious metals, how are some of the macros that actually matter or matter in your trading, or how is it that what are the things that you can keep track of? So that's the whole idea. So uh, this is a brief. So we have a fairly mixed situation globally. So we have a situation where globally most markets around the world, equity markets around the world, are at lifetime highs or at close to lifetime highs, and especially the US markets which are at lifetime highs. So India's position, we are there. We were not done too badly, so to speak. We were also very close to our lifetime highs just maybe a couple of weeks ago. So in that sense, not too bad. But it's not like we are outperforming the world like we used to. And another thing is, the very super performance that precious metals have had in the last say few months, and also how the various currency pairs have performed against the dollar. And in fact, the third point is actually quite interesting. Sir, I'll let you come to that in a little more detail later. So, about US markets, I mean, finally, end of the day, what happens is the US markets is being about 20-25% of the global markets, has a fairly decent influence on what happens around the world. A lot of liquidity that goes into global markets uh, comes out of the US. So that's the reason why the US markets are indeed quite significant for us. Uh, this again, of course, I'm talking about from a very pure equity point of view. There are issues with the US markets. Just before that, let me just take a step back. I mean, last week, for example, was dominated by talk around the Federal Reserve meeting. The Federal Reserve, of course, is the equivalent of our Reserve Bank, uh, quite actually close. The Federal Reserve operates with two mandates. One is price stability, which means they are not allowed to let inflation run above a certain level, and they are expected to keep inflation around a certain target, which is actually 2%. There's no logic for this 2%. The 2% is inflation. This is inflation at a top line level, which is basically consumer price inflation. So there is no logic for this 2%, so to speak. This is just a number that the Reserve Bank of New Zealand came up with a few decades ago, and that number just stuck. So that's one mandate they have. The second mandate is employment, the labor data. So basically growth. So growth measured in terms of the jobs market and price stability are two of their mandates. So the last week there was a Federal Reserve meeting, and the whole discussion. By the time the meeting actually happened and the outcome of the meeting was announced, the market said priced in 100% probability of a 25 basis points rate cut, which finally came in. So what markets were looking at after that was, the press meeting that usually happens and the statements along with the rate cut announcement. And the rate cut announcement seemed to be fairly mixed again. So the like our RBI, the Federal Reserve also takes decisions based on a committee basis. It's voted. The Fed chairman, Jerome Powell, currently has a veto power. But otherwise, it's basically a voting that happens. So again, there's a fairly large divide amongst the Fed members as to what is the next action. So markets are reading quite a bit or try to analyze quite a bit about how uh, what the statement means. So what different people are saying. So the last couple of months have been pretty sketchy in terms of data from the US markets because there was a government shutdown and so on. So we get a lot of the key data over the next couple of weeks, especially the coming week. So I guess there will be lots of ups and downs in terms of expectations as to what the Fed's next action will be. So why is the Fed important for India and Indian equities? It's more a sentiment driver, not really a liquidity provider. Uh, and it is important more from a sentiment point of view. Let me put it that way. Guys, please interrupt if you have any questions or please don't wait. Can I move on, please? Yeah,
Yes,
thanks.
Rajesh. Yeah.
Yeah, sure. Thanks. So now, what are the few things that have been driving geopolitics, right? I mean, geopolitics, and in fact, the year began with geopolitics being a very important part of the global economy. We had tensions in the Middle East, which seem to have abated for now. The Russia-Ukraine issue continues to fester. There does not seem to be an outcome. And one of the things that was expected from a Trump presidency was that he would be able to kill the whole issue quite quickly, which never happened. So those two spaces we'll have to keep watching. Another thing is, what is it that is in store for Europe? I mean, there's a lot of focus on the US right now because there was a government shutdown, and there's this Federal Reserve meeting. Data from the US was not coming on, and so on and so forth. But what is it that is going to happen with Europe going forward? The fact is there are lots of strains of weaknesses across in terms of the economy as well as on the political side. A lot of countries have pretty severe political issues. So that's again a space that probably will play out in the next year. Now, I'll come to precious metals in a little more detail later, so I'll leave that for the time being. Look, this is a discussion that probably has never that does not have a logical answer or a solution to this. Indian markets have always been expensive compared to the rest of the world, especially the rest of the emerging market world. Probably the US valuation premiums are if seen in isolation of a few stocks are probably way higher than India. But as a whole, if you take the market as a whole, it's not as rich as Indian valuations. The reason for that is on the US market that the growth or the spurt in growth was driven primarily by the top 10 stocks. The rest of the market is pretty undervalued still now. So this valuation premium has been a problem when it comes to FPI or FII activity. So that is a problem that will have to resolve itself, right? Only two ways valuations can change. Either valuations have to come down, which means market caps have to come down so that the PEs and the price to books look better, or obviously the earnings have to go up, right? Neither are happening. Um, Yes, in fact, if you look at long-term averages, I think we have come back to long-term averages in some parts of the market. But the problem with long-term averages again is that the long-term averages were anyway high. So that's a problem. We've seen rupee falling quite a bit. We are the worst performing currency amongst the reasonably respectable currencies. We're falling 5% year to date. The fact also is that there are other markets which are looking fairly attractive. There are markets which have underperformed, which have done quite well in the last 1 year, like for example, Hong Kong or Korea, which have done quite well. in the recent past. And of course, there is the US, which has done phenomenally well, right? So, and also, just for perspective, our repo rate, which is the Reserve Bank's benchmark rate, is at 5.25%, whereas the US benchmark rate is at 4%. So there's really nothing much to choose from, between a dollar bond risk or a India bond risk in terms of yields. So why would someone actually do take a inordinate amount of risk to sort of get into rupee bonds at this point of time? So these are all problems when it comes to foreign flows, and those things will remain. So what is required for that to change is a significant change in terms of how our positioning is in terms of reforms, in terms of our ability to project to the world that we are an economy that, despite all its problems, grew at 8.2% last quarter. And yeah, we whatever projections that come from the multilateral agencies like the IMF or the World Bank puts our growth to be the largest in terms of the larger economies for the next year also. So there is growth potential, but I think there are a few stumbling blocks that we still have to get over. So what has kept us close to all-time highs? Domestic liquidity, clearly, right? I mean, the foreigners have not been buying. A lot of retail has come into the market over the last 4 years, 5 years, especially post-COVID. That is a problem, and of course, that is not a problem per se. The problem is that most of the people who have come into the market over the last 2 years are probably getting a little disappointed now. So in fact, very interestingly, the narrative was that the FIIs and FPIs were selling, but the fact is retail also has been selling over the last 3-4 months. This is because no one who is new to markets, say over the last 5 to 7 years, uh, they've never seen a large dip, so to speak, right? We've been living in a buy on dips, sort of a phase for what, a little over 4 years, 5 years now. So that is indeed a problem. But yes, there's enough liquidity coming into markets, just because we are under invested as a country. I mean, 4% is what our 4% is our participation in equity markets. So there's a long way to go in terms of liquidity. Uh, are we immune to what happens in the world despite this liquidity? We are not. The fact is, one large correction could dry out this liquidity quite a bit. A 15% fall, and I think this liquidity will probably just go away. This is a sore point, and this is something that that's been affecting Indian equities, our currency, even our bond markets quite a bit. We are one of we carry right now the one of the largest tariffs, barring a few other one-off countries. So this is a big problem indeed, right? Despite being the fact that the US is indeed a large market for any country in the world which wants to be an exporter, uh, we have not really been able to get to a logical conclusion. Of course, a lot of it is politics. A lot of it is just economics. But there are a few industries which have been very badly hit by this. We are yet to see the real effects of it so far, probably because it's just about 2 months old right now. And then there's a lot of front loading that happened, so which is also reflected in the last quarter GDP numbers. But the fact is, sooner or later, this is going to catch up with us unless we see a resolution, quickly. So, a resolution is something that everyone's been talking about for a very long time. You keep hearing stuff like, India going to the US. There is a set of people coming here, a set of people going there. We see comments from our commerce minister. We have seen a fair amount of comments from everyone from Trump downwards. But the fact is, we still don't have a resolution. whereas pretty much every other country has come to terms with it and have moved on from there. So this is a problem that has to be solved. Like the slide says, this is more a tactical thing than a strategic thing. So yeah, I guess look, I like everyone who trades markets. I also firmly believe that 𝘼𝙡𝙜𝙤 𝙏𝙧𝙖𝙙𝙬. So price is king. So we trade price action. The global or a macro backdrop just helps us, with a perspective. It should not influence. Actually, it depends on what kind of trader you are, right? Anyway, that's a more philosophical discussion. We can have the data, but let me just stick to what I have. So what's happened with gold? The story about gold being a safe haven asset and all that uh, it is indeed the truth. But the fact is we have moved on from there quite a bit. So over the last 3 years, especially 3.5 years to be precise, especially since the Russia-Ukraine or Russia, sort of starting the conflict with Ukraine. That is what really spurred the demand for gold, and that is because that is based on real facts. So Russia at that point of time had, I think, roughly 250 to $300 billion worth of assets sitting around the world. And I guess they never expected that the action would first start there. Action against them would first start there. So the fact that your reserves, your foreign currency reserves, sitting outside your country is vulnerable was something that nobody had taken cognizance of till then. So that's what really spurred that first move in gold. Uh, After that, there is a very constructive move from central banks around the world into gold. So you move away from US treasuries, European treasuries, and so on, into gold. Uh, and that is what sort of has kept gold going for a long time. Uh, the factually what's happened in the last 6 months is that central bank gold demand has not increased significantly. But now what you're seeing is, you're seeing a lot of ETF demand coming in, which means, you're seeing central banks probably taking a step back. ETFs buying because, retail wants to buy gold. And three, you're seeing a fair bit of other players coming into gold. And the fact is, the players are, I'm not sure how many of you understand or know of, cryptos like stablecoin. So stablecoin is very unlike your usual cryptos. So stablecoin, to be to put it very simply, stablecoin is backed by actual assets. So the largest stable coin in the world is Tether. So that is actually was used to be backed almost entirely by US treasuries. So which means there is they are invested in yielding assets. Gold is not a yielding asset. I mean, except for our sovereign gold bonds and so on. There are very few other things that which provide you a mechanism of actually getting gold to yield you anything, right? Except principal appreciation. So, so we have a scenario. You saw people like Tether buying gold. In fact, this particular entity was the largest buyer of gold over the last 3 months, even more than central banks. And we still haven't seen the larger players such as the larger sovereign wealth funds and so on getting into gold. Or there is no anecdotal evidence of that. So what happens if that also happens? So that's kept gold going. And gold is a long-term story. I don't think there is any two ways about it. Uh, I don't know whether there'll be a correction or not. Uh, it looks very unlikely. I mean, maybe you will see a 5% dip. Uh, Very difficult to see anything. So that's a one-way story for quite a bit of time. Unless someone actually finds out some way of making lab gold or something like that. So yeah, so that's about gold. Silver is a very different story, actually. Look, one thing, please remember this. Any story you hear about, the demand for silver from industries, from solar especially, which is real. But please understand that, the commodity market is very, very especially fine-tuned, very efficient market out there. I mean, it's a market. I'll give you a sense. So you know the Scandinavian countries like Finland, Norway, and so on. There are villages. There are basically entities based out of these countries which are able to trade the spread between gas prices, sorry, not natural gas prices between different countries. The spread of gas prices between countries are traded. So that market is very intricate. So they understand the demand supply part of it perfectly well. So all that is priced into the price, so to speak. So there is no new demand for silver that's going to come in unless there is some chip or something that comes up, or a GPU that comes up that requires silver. So all demand for silver is priced in. What's really happening with silver is that you know the ETF flows into silver just exploded once silver broke out. So the ETFs got inflows. So the ETFs have to be, necessarily by definition, they have to have the underlying, right? So there's no way you can take, I can't take money. If I'm an ETF, I can't take money from you for silver and not have the physical asset with me. I mean, the case in point is what happened to the RBI, right? RBI issued the sovereign gold bonds because they're actually having the entire metal with them. So, and that really blew up in their faces, right? So an ETF is, of course, a central bank is a different thing, but an ETF cannot do that. So suddenly the ETFs went out in the market and started buying gold and they were desperate for gold. So, you really what is, I can't really call it a short squeeze. You're a sort of the demand from ETFs just exploded and silver just broke out. So now silver is trading at levels which I've never seen before. But silver is a very funny thing. Of course, I can talk about silver quite a bit, but the fact is, whenever silver has broken out like this in the past, and if past was, say the past is something that we can look back to, silver is always corrected from these kind of highs quite a bit. So very honestly, if you ask me personally, I'm not very bullish on silver anymore. Will it go to $70 or will it go to what? 3 lakh rupees in India? I don't know. But it's not a long-term story to my mind. Of course, I'm happy to change my view if there is indications to the contrary, but I don't think it's a long-term story. This is just my personal view. So yeah, to summarize, US equities, yes, incredibly high valuations, driven by a few very incredibly large companies and incredibly amazing companies too. No doubt about that. But how much? I'm pretty sure everyone would remember about a month or so back, there was a story about the amount of investments that was going into AI, artificial intelligence, and the numbers are mind-boggling. So this year, the spend, which was estimated to be around $250 billion when the year began, has already exceeded some 380. It probably exceed $400 billion this year, and is expected to be a little north of $500 billion next year. So that's a big story. I mean, it's not like earlier this spending was funded entirely by equity. Now the spending is funded in large part by debt. So there's a debt angle also to this. It's a big story. It's a very complex story. But yes, there is reason to be probably cautious. And I think that's the way it will be. So a lot of questions to be answered, a lot of things to be proven. So yes, very interesting times for US equities. Yeah, Indian equities, to whenever ask me, what I think of equities, my only thing is that do not look at Nifty. The Nifty 50 is not the market. Please look beyond Nifty 50. And the factors, if you look at it, I think there are lots of good, I wouldn't call it a bargain, but I think there are lots of stocks out there which probably, demand attention. So from an investment point of view, I think there is, if you're a very astute investor, uh, lots of good opportunities out there. Rupee per se, I personally feel, this is again a very personal view, that it's oversold, or rather overbought when you look at from a dollar rupee point of view. So yes, 90-50 doesn't look good. And not that was not my base case 2-3 months from 2-3 months before. I was thinking that by now, we would have had a resolution on these trade talks, and rupee should have drifted back towards 87. So that not being the case, we have seen 90 break. So now probably the 90 is a new normal. So, so if you had asked me 6 months before, I would have said the median would be 88. Now I would think the median is probably 89 to 90 and not 88 anymore. So tough times, but and also very event dependent. So let's see how things evolve there. Gold, like I said, bullish in the long term. Uh, Definitely buy on dips when you get an opportunity. And what can happen in gold is that if you get a 5% dip, you will see probably a little bit of the FOMO crowd getting out. Will probably give you a better opportunity there. But yes, gold is a long-term story. Silver, trade silver. I don't think it's a time to be an investor in silver. So yeah, this is broadly it. So happy to take any questions if anyone has any questions.
Hey Rajesh, this is Tanmoy. See this view that you have given, right? I would say it's a balance, right, in terms of what's changing in the AI world. So how do we capitalize on this? How do we make money out of this?
Any particular asset you're talking about, or
I mean, from an overall perspective also, right? Whatever Trump is doing, that's creating a lot of volatility. But again, the US economy is not as it seems, right? The
right?
investment that is happening on the AI side also is like it's skyrocketing as against expected, right? These estimates from 2015
Hmm.
today they seem like far too low as against what has already transpired, right? And there are already powerhouses which are playing the game like the Nvidias of the world, right? So obviously,
Hmm.
in the situation right now, I mean, we either onboard this rocket or we wait for a significant dip. So how do you think, right, from someone who is residing in India can capitalize on this entire stance, right? Should we go for this, ETFs which are basically on this FANG and
Hmm.
MANG and all of that,
Hmm.
right? Or just stay out and wait out and see how the situation translates because at the I think by the turn of this decade we would see some significant directional move coming from where we will be, right? And this AI bubble would have taken some kind of significant nuanced viewpoint rather than where it is going right on.
Hmm.
That's why I
Hmm.
would check in terms of what can we do to capitalize.
Okay. Um, I would say, the best way of playing this is uh, average out. Like you said, I mean, I agree with you on the next 4 years being pivotal in this whole story. So uh, let me just give you an example. Uh, some of the companies which are doing extremely well in the US before the Mag 7 actually just took over the whole stage. There are companies like Salesforce, a couple of others companies also which were doing quite well. But then every what happened was money started chasing only these 7-8 stocks right after that. So within even these 7-8 stocks, I believe you will find your opportunity. So uh, I would not recommend a ETF right now, at least for the next 6 months. I would think going stock specific right now is probably a good idea. So you would have noticed the way, for example, Google just came up, Google, which is Alphabet, just came out from behind, out of nowhere, They were behind the race in the AI space, and they just came up from behind and just they're giving OpenAI a pretty good run for their money right now. So and Google has returned what 60% over the last 3 months. And that's amazing, right? A company which is valued at $3 trillion or $2.5 trillion growing 50%, 60% is amazing. So I think you have stock specific opportunities. So definitely start investing in those stock specific opportunities. I know that's a lot more work. Even I would also honestly prefer just buying an ETF and sitting on it. So indeed, if you want to go the ETF way, my suggestion would be if you want to buy 10 units, start with one now and add at a 10% dip here or there. But otherwise, my preference would be to go look at a stock specific strategy.
Okay. So fair point. See, I'll tell you, I was reading this data for US, right, in terms of the AI investment, and these four companies, including Facebook, Meta, basically, Alphabet, and all that, right? In 2023, we were seeing a significant jump in terms of what their AI investment was, right? I think around 20% of their total spend was in AI, right? And then I saw some increase in 2024, right? Now, at that point of time, I was not able to interpret in terms of how this will play out in the longer term. What I did was in 2024, sometime in this September, I bought this one of the ETFs called Mafang, right? And at 90 rupees from India, right? And I think it's now trending around 140, 150. So that was if you think from my approach perspective, I had the data and everything in place, but the approach was very conservative. Least aggressive play with that ETF. So that's where I felt that I missed reading the data points that were significantly showing that there's going to be a boost. Number one, because of the AI investment. Second, because of the Trump administration, right? He being whatever he is, he will try and bring that. He'll get out of the neutral zone. So I felt I missed that read completely.
No, I get what you're saying. That actually happens with everyone. So for example, I was long Tesla for a long time, and that went off well, but I think I exited a little too soon. And like you said, the writing was on the wall because a lot of things were falling in place for Tesla, despite all the noise around Elon Musk. So yeah, I think that happens. That's part of the game. But so I guess stay invested in the US. I mean, that is there is no other market in the world which can give you the kind of alpha that the US can give. Um,
Yeah.
at a very in fact, look, in India, if you want to get alpha the way that you want to get in the US, so okay, let me put it this way. If you want to get a stock in India, a very big company stock in India, which can give you a return of 50%, can you think of one? I guess there are a few, but it's so difficult, right? Whereas, something like an Alphabet or a Meta can possibly give you a 30-40% return in 3 months, 4 months. Absolute return, not even annualized. Uh, you're saying, yeah, you cannot not be in the US. That's the reality.
No, fair point. I mean, see, the thing is, you're absolutely right. If I were to invest, right, I would invest in a US stock versus an Indian stock because the long-term prospect of that is much, much higher.
Yes.
The second point is over between COVID to now, right? What has happened is there is a lot of valuation, increase that happened for company, and now they are feeling the pinch. You gave the example of Salesforce. True, Salesforce is reinventing itself with AI that is being integrated. Right, earlier it was just a CRM solution or book of records. Similarly, Zoom was supposed to be the de facto business collaboration tool. But what happened is during COVID, the valuation reached so high that their estimates started skyrocketing. And today, if you were to look at Bloomberg, it's not there, and the business proposition is also low. So especially in the SaaS side, right, there's a lot of changes that are happening. So how would you read those elements in the US market, right, from an outsider's perspective? If I were to invest in US stock, how would you read it? Would you go into manufacturing, technology, SaaS? How would you take that estimation, saying that hey, this is the industry that I want to go to first?
SaaS, yeah, SaaS will always be a play. I think it's pretty sad that in India it's not as big a play as it is in the US. But I think SaaS will always be a play. Uh, I think a lot of some of these themes are still evolving. For example, would I buy into an OpenAI if they list? Honestly, I don't have an answer to that
Okay.
because I think let me just take an example of OpenAI, right? I mean, that's an exciting company. ChatGPT was, the king, 4 months ago, and over the last just 3 months, things have changed so dramatically. OpenAI, I mean, Gemini downloads are beating OpenAI. Some of the other players are catching up very quickly. Very exciting niche products out there. So things are slowly coming to play there. So I would think, Tanmay, that I think we should probably give it a little time. Uh, just in terms of stocks. I mean, I think you also spoke about Salesforce. I'm very bullish on Salesforce. So I'm moving a little bit of money into Salesforce now, and I'll probably try keeping the play going on there. One exciting space other than tech is possibly pharma, and I think Eli Lilly is just the beginning of it.
Mhm.
I think, I mean, I don't know whether you have noticed what's happened in the last few months is uh, the FDA, which is basically the Federal Drug Agency which is basically the regulatory body for pharma in the US, has a sort of designated obesity as a disease, right? So which means, which is also, and that news came out a lot later after the Eli rally. So I think it's a beginning
Okay.
of a few things. So pharma is interesting and undervalued, except for a few stocks like Eli. Uh, so I think that's an interesting space to be in. Manufacturing, honestly, I don't understand that so much, so I don't want to comment on it. And honestly, there's no company that really caught my eye there. Uh, Possibly it's there, but honestly, it's just not been in my radar. So I'll stick to tech for the time being, and a few plays like pharma. Oil, no, I don't think so. Okay, just one thought. I don't know whether I could be very wrong on this. So we have seen a precious metal rally. We have seen some of the other metals take off, like copper has taken off. I have a
Mhm.
feeling that oil is in for something. Either oil is going to crash to $40 or is going to go to $80. I don't think it's going to hang around at 60. So maybe there is some play in oil going forward. So I keep tracking that space. Very boring, extremely frustrating, but I keep tracking that space quite closely.
Fair point. So, Rajat, how are you investing in Salesforce?
So I have this account in the US.
Okay.
I already have an investment, so I keep adding to it. So there is this LRS route that you take, the liberalized remittance scheme. So
Okay.
I started in 2022 December. So I keep adding every year there.
Okay. So, anyone from India can invest in those schemes?
Yeah,
I can
yes,
do
yes,
some
yes,
research. Yeah.
yes, indeed. So I use this app called Ind Money, IND Money.
Okay. Okay. Okay.
I'm pretty sure there are lots out there. I use only this. I'm pretty sure there are other players also out there. And my
Fair enough.
experience with Ind Money has been good. So that's the only one I know. But I'm pretty sure there are others out there.
Yeah, no, I've heard about in money, but I did not take that route so far. I was just going to ETF. In fact, your viewpoint on Salesforce may be correct because what's happening is, the in the tech domain right now, a lot of these
Mhm.
companies which are being considered as ready for evolution into the next level, right, somehow have realized that whatever is the concept of agentic AI, right, they are not even close
Mhm.
to, having a RPA done properly, right? And agentic
Okay.
AI is far out of their reach. So what
Mhm.
Salesforce has basically done is they have created that layer which can at least do the RPA and the automation part of it, and evolve them further so that additional solution in getting integrated to the entire view, look and feel of it, right, is actually a game changer for these companies because they can reduce their support cost by almost 60 to 70%. Now,
Oh.
what the companies are doing is whether they are going for a all-in solution using Salesforce alone, or they are going for a stitch solution because their current tech stack is also different. They have got Oracle integrated to Salesforce with some Shopify app, something else going on the ERP side. So that's the take, right? I know Salesforce will grow, but is it the only one that will grow? May not be true. But there is a definite scope because the companies have realized that agentic AI, which has been sold to them 2 years ago, they are far way behind on that. Big companies,
Right.
large organizations are way, way behind.
Very well put. Very well put. Yeah, I agree. I agree.
So, last point, Rajesh, I wanted to clarify. See, what I have seen is, as the interest rate dips, right, the index goes up. So, what do you think right now? I think index is, the dip is happening across both the US and the Indian market. So, do you think the RBI rate will play out, and including the US rates will play out in terms of where we will see the Dow Jones and Nifty?
No, I don't think it will matter so much. Look, I think RBI is definitely at the lower end of the curve here. I guess they cut just for the heck of it this time, honestly, if you ask me. There was no real reason for a 25 basis points cut here. But uh, will the RBI be able to cut more, and will that enthuse Indian markets? I don't think so. The factors beyond this, bank's ability to pass on this interest rate cut, I think is fairly limited from now onwards. So whatever the 1% cut, the 100 basis points cuts that have happened before this has been passed on quite okay by now. In fact, that pass on took almost 9 months. But another 25 basis points or 50 basis points cut from here from the RBI, I mean, I personally don't think they should do it. But even if they do it, I don't think it will have a significant impact. What is important is in terms of what they do on liquidity. So this particular RBI governor, he's completed a year now, was very bullish on liquidity, in the sense, one of the things that he had put out when he had joined was, I will make sure that there is enough liquidity in the markets for everyone and everything. So we will not let liquidity be a constraint. So I hope he sticks to that. Last 2 months has been difficult for liquidity a little bit, but I hope he comes back to that stand and not really on the interest rate driver stand. So I guess this rate cut had a lot to do with the pressure from things like the trade deal not happening and so on and so forth. But I don't see one more cut happening. Will the Fed cut from now on? Again, I have the same view. I don't think they should cut, or I don't see a reason why they should actually cut. And I think it will be very counterproductive for them to cut once more. It's quite dangerous territory, actually. So I think, but the problem with the Fed is that, the current, the Fed chairman, the Fed chair, he sort of, his term ends in May. And obviously the next person who gets appointed will be a Trump appointment.
Yeah.
Okay, Powell is also a Trump appointment, by the way. So yeah, let's see how that plays out. But yes, that could have an impact. That will have an impact for sure on US markets. In fact, if you remember, just a month ago, there was all this talk about the AI bubble. I don't know whether it's a bubble or not, but the investments in AI are they good or bad, or is it too big or too less, or not too less, too big, and so on. And that suddenly went away because the expectations of the Fed cutting just became a big noise, right? And the markets moved up again. They fell, and the US markets have fallen nearly 3%. No, sorry, or nearly 5%. From there, they're back, and they're back above that. So yes, that matters. That matters quite a lot. I hope I answered you. Yeah.
Yes. So, see, that's correct, right? So, see, where I'm going from is right now, from my view perspective, right? If I were to look at Nifty EPS, right, it's around 1,050, 1,150, right? If you were to consider the PE that it is at 22.6, 22.7, right, and where it stands. From our production, right, where we are seeing is that there should be at least a 10%, growth in the next financial year, for that matter. So this with the interest rate being cut, right? Obviously, there will be some kind of impact to it, and I think that even if the EPS moves in by that 10%, we are looking at a very bullish scenario in 2026 somehow. That's what I read, and I think our sectorial changes that while right now at this point of time for the last 1 month, I'm seeing that Nifty being influenced by the top companies is showing more of a conservative play for the big players trying to park their funds right now. But there could be a takeoff when mid cap and small cap start breaking out. That's how I'm reading it, and I'm thinking that I should capitalize on this. I don't know. I could be wrong for that matter. But tell me, what's your read? Do you see that the funds are being parked in large cap right now for an impasse or, kind of a, temporary phase? Or do you think that this is going to be more of a norm and, the large caps are going to do better than the mid and smalls?
I still believe that at least for the next 6 months, the large caps will do much better than the small caps or mid caps. There will be outperformers, of course, in each segment. Each size segment, so to speak. But I would still bet on large caps for the next 6 months.
No. Thank you. Good point.
So yeah, thank you, folks. So if there are no more questions, we'll call today. Thank you so much for joining in, and good day and good
Yeah,
night.
I just wanted
Enjoy
one
the
more
rest of
question. Rajesh,
Please,
this is
please.
not for you. This is more for Anchal. Anchal,
Ah,
just on the, I'm doing your buy strategy that you had shared, right? Um, on Nifty or Sensex. I will just give me 1 second. I'll just check. Do you see a difference in that in terms of your actual execution versus the backtest results?